everyone, welcome to Investing with Upsurge. Our guest for today's podcast is Mr. Alok Jain, the founder of Weekend Investing. You must have already seen him on Smallcase or even on Twitter, where his tweets are filled with logic and great analogies. In today's podcast, we'll discuss the journey of Mr. Alok Jain, whose Smallcase became one of the most famous small cases that the country has ever seen. So let's welcome him and get this started.
Hi Alok, thank you so much for doing this. First of all, how are you doing?
Hi, Sanjana. Thank you so much for inviting me on your podcast. I'm doing well and trying to live in the smoke in Delhi.
Oh, that's really sad. But to start off, you graduated from IIT Delhi and you also went into the markets then, probably started your own company a while later, Weekend Investing. How does this entire journey unfold? Could you walk us through the timeline?
So I'm pretty old for the purposes of your audience. I've been in the markets now for maybe 28 years plus.
Yeah.
So I graduated in 1991 from IIT Delhi and then went to the US for my master's in science. While I was doing that, I realized that, I was not cut out for academic research or staying back in the US. So I switched my lines, went to the business school, did a master's in finance and an MBA. Then once that was about to get over, there was this new opportunity in India that was opening up. National Stock Exchange was forming at that point in 1994, 95. So I decided to sort of do a startup at that point. Got some investors from family and started a new business without any experience, just jumped in, came back and started a NSE membership. That went on for a good 2 decades. Sometime in 2013, I decided to, get out of that business. The Zerodhas of the world had crushed the brokerage business.
Yeah.
And the entire business dynamics had changed. It was more, additional value creation that was sought in the market. Brokerage became a plain vanilla sort of a transactional business, which was available free now. So I moved out of that business and kind of started something on my own, actually. So about in 2013 onwards, I thought, I've done enough of this corporate life, having a team around me, 20-25 people team. Let me just do something on my own, have a very small setup, just work from home. So I started to build, strategies for my own capital, so that I could run them and just pay my bills, just be, out of this entire rat race. A couple of years down the line, I got really bored sitting at home and doing this by myself. So I started to share my strategies on Twitter. Some following started from there. Some articles were written about these strategies. And people started to ask me about, why don't you do this as a service, as an advisory? And then this again started. We went on and created a business around weekend investing.
Okay, quite interesting. Moving on to the next question. Since you finished your MBA, as you mentioned, from the US in the 90s, I think. So, during that time, did you pick up some developments from there and probably, thought of this, that, there's a gap in India that I can fill back at home. So, was there something that you identified in those markets and probably took back home?
Yeah, so once I decided that I'm coming back and I'm going to be running a stock brokerage house, of which I knew nothing about. I mean,
Yeah.
I had never seen a share certificate in my life. And in those days, everything was physical documentation, physical shares. Just the entire dynamics of the stock market business was very, very different. You did not have, daily settlements. There were settlements in 2 weeks. Your person will have to carry physical shares to Bombay from Delhi to deliver shares that you were sold, bring back a suitcase full of, stock certificates, the ones that you bought, and physically distribute them. So a lot of things were very, very different from what I saw in the US. So I thought, why not, have a internet-based system. In 1995, nobody was talking about an internet-based brokerage business. So I created a business plan around that. I presented that to NSE,
Oh,
and I started to implement that towards 1998. It took me a couple of years for that software development to happen, where people would, the idea was that people will, dial in to our servers at
hmm.
our office, and then we will connect them into the main stock market system, because this current system that we have on NSE was not available at that time.
Oh, okay.
And then, after having spent a couple of years and a lot of money on that project, this 2000 crash came, and it kind of just eroded all the confidence that I had in terms of how to take it to the market. And the capital was gone, and the time was already sunk in. So we shelved that project. But by that time, India Bulls and a couple of others had also come into the market.
Hmm.
So we missed that boat of being one of the first ones to sort of launch an online transactional platform at that point of time. So that was something new that I was trying to bring in, but I guess my timing went bad at that time.
But so you, as you mentioned, people used to have physical share certificates and everything. Now, building an audience at that point in time would have been really difficult, right? So, was there a way that you probably approached people or created awareness about this whole platform?
So brokerage business in those days, in mid 90s, was very relationship oriented business.
Okay.
There were only, for instance, in Bombay Stock Exchange, a couple of hundred brokers,
Hmm.
and they would work like for a few hours a day, then play golf after that. So it was a very, relaxed business with a closed, like big boys club.
Yeah.
So nobody could really get in, and those who were already in were like were essentially demanding whatever margins that they liked. I mean, brokerages could go to 2 to 3% also.
Oh.
So it was a huge margin business, although on low volumes,
Hmm.
because the transaction was so difficult. If you wanted to buy a share, you would call your sub broker, who was linked to your broker. So your buy order would be sent by via phone to the main broker, let's say on Monday, and till Tuesday you would not know if your shares were bought or not.
Oh, okay.
And then, once they were bought, let's say by Tuesday evening, you would know whether your shares were bought or not. Then you will send the payment by next few days. Then 2 weeks later, those shares would arrive. So it was a hugely long, inefficient cycle of how things used to work. And then once the shares used to come to you, you were not sure if the signatures of the seller would match in the company's record. There was something called a bad delivery, which today's generation would not have even heard of.
Hmm.
So those shares would then go back, take another month for the rectification to happen.
Oh.
So it was so difficult to do business. And that's why, the volumes were 200-300 crores per day, not like the lakhs of crores that happen today. It was a very, very different ball game at that point of time.
Oh, okay.
Uh,
Yeah, I think I got a lot of insights about how the 90s was in India because I think I was not even born at that time. So this is quite insightful. But we would really like to know what was the first stock that you had picked in the Indian markets? Like, how did the young Alok approach the Indian markets?
Frankly, I mean, I don't remember, but I was never, a stock picker or an investor of my own. So my entire focus was on how to run the business.
Right.
And on the side, we used to do a lot of research for our clients. So this entire thing about offering value-added research to our client started from late 90s for me, where we used to do some research for our clients and tell them what to buy and what not to buy, and how to do dividend stripping, and how to get special situation stocks, because I realized early that I mean, if the transaction is what I'm offering, then everybody can offer that transaction. I mean, what is the value add that I am doing? If I have a NSE membership, there are 1,000 others who also have it. So there was no value addition or a unique USP as such for that transactional part. So we got into some research, but when you are focused on research and you're providing that service to your clients, you forget about your own portfolio. I mean, my own money probably was not most efficiently used at that time. But I think all these new age companies that came around, including the IT companies, Infosys, Satyam, and in those days there were many IT companies, which probably today nobody would have heard of, Pentafor, DSQ Software. These were the running companies which used to in 99 2000 went 20 times, 30 times, 40 times kind of gains. Himachal Futuristic and all those kind of companies. So somewhere I must have made some investments on that, and again on momentum basis, on trend basis, got out before they crashed for totally.
Oh,
But I tried for I think a decade and a half, and I could not get the hang of this, being too patient and being fundamentally, attached to stocks. So my mind was always moving into the area where, how to minimize losses when markets fall, how to exit stocks, how to not be emotionally attached to stocks. So, there was a lot of behavioral part that was involved in my thinking, that where I saw that we had about 1,000, 2,000 clients who I was servicing as a brokerage house. And I realized that most of them are not making money because of their design of their investment thesis. It was either by luck, or somebody got inheritance and they were just sitting on those stocks, or somebody just happened to buy some stock at the right time, purely. So I could not find too many people who were consistently able to call the market right,
yeah.
pick the right stocks, consistently able to make money, and everybody was going in from a boom bust cycle. So in the boom cycle they would make money, in the bust they would lose everything or most of it. So
Oh,
that was playing on my psyche, that how can I beat this system where I make money when the market goes up, and I don't want to lose all of it when it comes down,
so how to
because
build
that
a
you
strategy?
want to build step by step on each cycle.
Correct, correct.
So that's how these sort of trend-based, momentum-based thoughts were coming in the back of my mind, which I didn't implement till about 2010, 11, 12. And then when I realized, I've been in the market 15 years and I haven't made any money for myself, purely on investment basis. Yeah, the brokerage was making some money, but as an investor, I was nowhere.
Yeah,
So I decided, I must make models for myself and run my money on that at least. And that's how all this, the background of momentum investing and then the weekend investing, branding, and all that started later.
right. So, I do follow you on Twitter, and I've seen some posts on, Charlie Munger's lessons and his early days and everything in his on his recent demise. So, are there any learnings that you've picked up from his life or his investing journey that you've, translated into your own workings?
So, I mean, these are, revered names in the market, whether it is Warren Buffett, whether it is Charlie Munger, so many other, market greats are there. In India also, uh, I think most of them do give this entire thesis of that you need to have a long-term view. Now, that long-term view does not mean that you have to, just sleep on stocks for long term. It just means that, in the long term, you need to have a strategy that you will continue to follow dispassionately. That strategy may be that you need to churn your stocks every year. That may be a strategy. The strategy may be that, I don't want to go deep into a when markets are falling, I don't want my portfolio to go too deep in the red.
Hmm.
So this is, I mean, if I were to take their thesis, obviously I am not in that camp of value investing or fundamental investing, but I definitely feel that having a long-term view on whatever strategy you are using is something that they propagated very well. Being patient with whatever you're doing is another thing. Having the right behavior towards the market. The markets is essentially I usually call it's a regret machine.
Hmm.
So, there are four things that you can do in the markets. If you buy some stocks and the stock goes up immediately, you will regret why didn't you buy more.
Right.
If you sell the stock and the price goes up, you'll regret, why did I sell? The price is up now. If you bought the stock and the price fell down, then you will regret, why did I buy at that price?
Yeah.
And if you sell the stock and price goes down, then you may regret, why didn't I sell all of my stock at that price? So it's a regret generation machine. Whatever you do in the market, it will make you regret about your decision, because nobody can catch the tops and nobody can catch the bottoms.
Right.
So you have to make the best possible outcome from the market without having a sort of a pressure on yourself that you did not take the right decisions. So hence this entire thesis of a non-discretionary way of investing. Non-discretionary means, for your viewers, that you are bound by rules.
Okay.
And you are playing a game systematically, and you are not having any discretion in those rules. If I say, let's say there is a rule that I will not buy any stocks which are below, let's say, 200-day moving average, for instance. If this is a rule in your system, then you are not having the discretion. You are saying that, if something is below this this moving average, I will not buy it.
Right.
I will only buy it when these 2-3 conditions are met. I will only sell it when these 2-3 conditions are met. Because what happens is, you buy a stock, and let's say the stock has done well. Just assume the stock has done well. You bought the stock at 100, it went to 200 rupees. Now, what is your decision at 150? What is your decision at 200? If the stock is, let's say, going to 500, how will you justify it to yourself till when you will hold? And let's say from 500, it starts to drop towards 200. When it will be that point where you will say, I will take a call and exit? How do you make those decisions? Because there are 10,000 variables. I mean, there are variables around the macros, how the interest rate and inflation is changing around the world. There is macro events happening in the government, how the government may be, doing taxation or benefits to a particular sector. Within the sector, a stock company may be having variation in terms of market share, or they're doing something right or doing something wrong. There may be management changes. There may be some market forces which are trying to, take the stock up or down. There are so many gamut of variables always in the market. And how can you, expect any person to have a handle on all these variables and come to a very precise decision in terms of buying and selling? It is virtually impossible. And there is so many people around you who will either confirm your biases, that what you're doing is right, or they will try to tell you the opposite, and you may lose the confidence in your own original thought. So for me, at least, I mean, I can't say for others, but for me, all this was impossible to do. I said, by stroke of luck, if somebody gets some good stocks and sit on them, maybe they can make some money. But otherwise, it's a very randomized game. And to make a winning out of a randomized game, you need to have a proper strategy. Just like when you go to a casino, and let's say you're playing the slot machine, you'll need to have a strategy. Okay, I'm bringing this much money, I'm betting this much money on this. If this happens, I will do this. If that happens, I will do that. So it's like a algorithm, a sort of a flow chart. So that's what ultimately we, at Weekend Investing, we crystallized our thoughts into these kind of frameworks, what to buy, when to buy, how much to buy, when to sell. These are the 4 sort of cardinal principles that we follow. And at any point of time, all these 4 questions should be clearly and precisely answered. There is no ambiguity.
Right.
So this is how you can create frameworks where there is clarity of what you're doing, because it's a business, right? I mean, you have to treat your stock investing, trading like a business, and you have to scale that business. Gradually, you need to become financially independent. You have to, make sure that it makes enough money so that you can let go of your other profession or business, whatever you were doing. And it is very much possible to do so. The only hindrance we have usually is our own self, because one is we don't believe in what we are doing is right all the time. So we have a question mark on our own thinking. Am I doing right? Did I buy right? Did I sell right? So if that question mark is there, then every time you will fear whether if I'm going to buy now, should I buy? Maybe it is not the right time. When you are doing non-discretionary system-based, sort of a quant approach to the market, then
Yeah.
you are totally away from all this. You are saying my rules say buy at this point these stocks, so I'm buying. I'm not putting my mind to it. So you are essentially taking your mind out of the game. Your mind is your biggest, enemy actually. So you take yourself out of it. You are seeing it from a distance, what is happening, and
Hmm.
you allow the system to go forth. Very, very simple, techniques people use, and they do well in the market because they don't get emotionally involved or attached to a stock. It's like, you don't want to marry a stock.
Yeah. Yeah.
Because when you buy conventionally, when you buy a stock, you read up so much about it, you will do research about it, you will buy the products of that company, people will reinforce your decisions,
You get
you know
attached to that company and then you take decisions as per that.
and when you hear so much about it and you've had it and it's given you some gain also, you tend to feel that this is the best thing and I should stick with it, whatever may happen, even if it drops to 80%, it's okay, it will come back.
Yeah.
But
Yeah.
that may happen or that may not happen, because things, we are living in a world where disruption is the sort of central force.
Hmm.
So whether it is technology based disruption, whether it is some geopolitics is changing, how import and export is happening in your country, or how subsidies are being given to certain sectors. So everything is changing very dynamic now, and very rapidly. So the new generation that is coming, things are changing very, very frequently. There was some study, I think by Morgan Stanley, that 20, 30, 40 years back, the average age of an American company in S&P 500 used to be like 27, 30 years.
Okay.
The average longevity of a company. Now that is dropping to like 10 or 12 years.
Oh,
So if you think that, you can just buy and sleep for the next 20 years and magic will happen, it may not happen. That entire technology may change. Your company may go bust.
yeah.
So you need to have an active, view of the portfolio, or you give your money to a manager, to a mutual fund, to a PMS or whatever, and let them take care of the money, sort
Right.
of. So these are some of the thoughts around this. Yeah.
So, talking about emotions and mind, how it plays in the markets, momentum investing, the strategy that you follow, is kind of counterintuitive, right? You buy high and then sell higher, is what I've heard about
Yeah.
momentum,
Yeah. Yeah.
which is quite, it doesn't come intuitively, right? Because value investing, till now, all we've heard about is you buy cheap stocks and then sell it at a higher price. That's what we've heard. So, how does momentum strategy work? Can you explain it to me like I'm like a 12-year-old?
Yeah. Yeah. So even 5-year-olds can very easily understand it because it is very, very simple.
Okay.
One caveat is there, that what is simple may not be easy. So what you're saying is absolutely right, that it is counterintuitive. So for instance, we all know that if we go in the morning and jog for 5 kilometers every day, we will be very healthy, right?
Yeah.
I mean, we'll be very fit. It's a simple exercise. It's a simple thought. But is it easy to do? No, it is not. Right. So similarly, to detach your mind from what you're doing is something that is a simple thought, but it is not easy to do. So in momentum investing, as you rightly said, we buy when stocks are already hitting highs, or have moved up.
Hmm.
And the underlying theme is that what is moving, like if you see in the Newton's law, that if a body is in motion, it continues to be in the motion until an external force is applied on it. So here also, the stocks that start to move are actually telling you that they are moving and they want to move further.
Hmm.
It is our shortcoming that we decide that if a stock has gone from 50 to 100, that we want to stop it there. You should allow that winner to run. You don't know that stock may go from 50 to 100 to 1000.
Okay.
Right. So essentially, this buy low, sell high thought, which is for conventional buying, I mean, you want to buy something from Amazon, that is fine, that you're trying to find the cheapest thing here. But in stock markets, in our sort of thesis, we follow the BBC principle, Bhav Bhagwan che. This is a Gujarati saying, which
Yeah.
essentially means that price is God. So the
Hmm.
price today of any stock is already, it is already discounting all the factors around it. So whether a company is doing well, whether people are buying this stock, what is the future of this company, is already kind of discounted in the price today.
Hmm.
So
Hmm.
when we look at in value investing, for instance, last 3 months result, we
Okay.
look at quarterly result or annual result. That result is actually of the past. It
Yes.
is a rear view mirror driving position that the company did so well in the last 3 months and hence it will do well in the future. We are extrapolating that,
Okay. Okay.
right? Whereas you would have noticed that after a great set of results, many stocks may fall. They've already run up.
Yeah.
Or if there's some bad news in the company, the stock is already falling, we don't know why it's falling, and then the news comes out that this result was bad, or this top manager has moved out, or they've lost this deal. So
Hmm.
market always moves ahead of before the news is out for the common man,
Okay.
and hence you have to believe in the price move. The price is actually telling you what is the truth of that particular moment. And in my thought process, while value and growth style of investing, fundamental style of investing is fine, but every stock, even if you've identified value, needs to move before you'll make money, right? I mean, you've identified, let's say, some company at 100 rupees, it has a lot of value in it.
Hmm.
But how will you make money out of it? Only when it starts to move, right?
Right.
And when it starts to move, the momentum filters will pick that. So without momentum, nothing can make money, right? I mean,
Hmm.
and momentum is sort of pervasive. It is not just momentum investing based on price, but even in when you're doing growth investing, value-based investing, you're looking for momentum in earnings, you're looking for momentum in market share,
Yeah.
or you're looking for momentum in some kind of margins
Hmm.
improvement. So you are looking at momentum actually in everything. Momentum is pervasive. It's just that momentum investing has sort of a bad name, in the sense that people say, oh, you're just following price. See, from a fund manager's perspective, now you have all these star fund managers you see all around every day,
Hmm.
and they give you very beautiful stories about what this company will do,
Hmm.
right? So it's an art of storytelling, based on some Excel projections that they make, that the company will do this or company will do that. Even the company management sometimes don't know, that these kind of projections are possible.
Yeah.
So you are essentially living in a dream world when you project something out based on your analysis. Whereas in momentum investing, what you're doing, you are allowing the mass knowledge and the price to dictate what you're doing. So let me give you a very small example. Let's say you go to the race course, and
Okay.
you are betting on horses there.
Hmm.
Now 20 horses, let's say, start the race,
Hmm.
and after the first round, let's say 5 horses are up in the front in the first group. There are 10 horses in the middle and 5 at the back.
Yeah.
Who will you bet on now? Will you bet on the fact that the horse which is in the last position, but he won the last race? Will you bet on him right now? Or will you bet on this front 5 group, that I know this group is leading, and 1 or 2 of these will be big winners out of this. So I'm betting on that group. I'm betting on the current situation that is presented to me. I'm not betting on the past laurels. That the horse that is currently last has won the Derby 5 times, and hence I'm betting on that.
Hmm.
So that is rear view mirror driving. What is actually on ground in front of your eyes, you're not willing to believe that, but you're willing to believe what has been narrated in fine stories and the past. So this is just a small example. So this is how, for instance, you take Nifty 50 stocks,
Hmm.
and let's say I'm applying momentum investing to this. Now what I will do is, I will select the fastest moving 10 stocks or 20 stocks out of this group
Okay.
and place my bets on them.
Hmm.
and I leave the last 30 out. So essentially, in that horse race, you are betting on the top 20 and leaving the 30 behind. Then after one round, and in this case, let's say after 1 month, I'll review that portfolio again and see that how many of those 20 that I selected are still in the front. If some of them have fallen behind, I'll let them go. I'll chuck them out of my portfolio. And the new ones who have come into this top 20, I'll buy them. So in essence, I'm betting on the top winners at any point of time. And I'm betting that some of these will do well, some of them may not do well. And overall, when I bet on the group, I will make money. So also to simplify this for you, let's say I do 100 transactions in a year.
Okay.
And only 50 I win and 50 I lose. How will you call this? I mean, is this good investing?
Not really.
Not really, right? So that is the general reaction that, I mean, this is nothing great. I mean, it's like flipping a coin. You're getting 50 right and you're getting 50 wrong. So what is the big deal about it? But the 50 I win get me, let's say, 20% of my bet each time. And the 50 I lose only lose 2% of my bet each time.
Okay.
So every win that I do, although it is 50-50, but every win is much bigger than every loss. So I have very, very, very small losses, but large wins.
Okay.
So when you combine this entire thing together, you made good money, right? So it's called the casino math. So where you go and you're doing 100 times that slot machine, and every time you lose $1, but every time you win, you get $100.
So this is
Right,
like the Pareto's principle as well, right? You make 80% of your money from 20% of your portfolio.
Yeah. So we essentially have in any momentum portfolio about 10% stocks that will really hit a 6.
Okay.
40% stocks will be like better than market. 50% stocks may be just small losses around market returns or below market returns. When you put them all together as a portfolio, it makes money. So that's where our usual fail is that we look at individual transaction as our that each transaction should win. But here you're saying I'm looking at a portfolio and I'm not worried about each transaction. I'm looking at as a whole group.
As the
And
total.
this entire group has to make me money.
Yeah.
And I'm not worried about, like, for instance, a lot of times when I do this and stocks come to me out of my filter, I don't even know what those companies do. I mean, sometimes those are new names to me. And what are they manufacturing? And I have no clue. And I don't care about it, because for me, the price and the volume action in that stock is telling me everything about it. I don't need to know who's the management, what they're manufacturing, what are their plans for the future, because the price encompasses everything. So that's the beauty of momentum investing. I don't know if your users will be able to get a hang of momentum investing basis this, but largely the idea is to keep your ego and your brain aside and follow a set of rules and stick to those rules like a military-like fashion.
Right.
Exit is clear. If that price comes, you have to exit. If that price comes, you have to buy. What you're buying has nothing to do with what the stock has done in the past. For instance, we bought Suzlon or something at 10-15 rupees recently. It's gone to 40 rupees. Now, if I were to have that baggage of the past, that the stock was at 400 and it came to 10 rupees, I would never be able to buy it.
Yeah.
That it's a losing stock always. But because you are seeing it from a fresh perspective, that any stock could hit a 6. So essentially, I mean, that's how you go about it, with set rules, not having any attachments to these rules, and just it's just a very peaceful way of investing. I mean, no stress. Once you get the hang of it, and once you've spent a year or two, I mean, you will forget about all other kinds of investing, because there's nothing like this.
Okay. So, I mean, you've explained it quite well, and I'm sure even I've understood how momentum investing works right now. But what I'm just making sure I've understood everything correctly. there is no research about the management, the numbers, the financial statements, which is required in momentum investing. So, are there any technical indicators that you use? Because this sounds a little bit like trading on a particular stock for like a month or two, and then exiting the positions when the price is good. So, is this similar to a little bit like trading using some technical indicators?
So good question. I would say, can you define what is investing and what is trading? I mean, how would you put that demarcation that this side is investing and this side is trading? What would you say? I mean, you are a person in the markets,
Yeah.
so I would like to know your view. When would you call it investing and when would you call it trading? Just
Okay.
because if it is it time based for you? I mean, if it's the duration of your holding is less than say X months or weeks or days, is it trading?
So for me, I think trading would be classified as something where we only see the price and the volume of how much the shares and the stocks are being traded. But whereas investing would be something like, getting in depth into the financial statements, going through
Hmm.
the numbers
Okay.
and management.
So there could be trades that could run for a year or two, but they would still be classified as trades then.
Okay.
Uh,
Yeah, right.
right. And momentum investing is also as vast as value investing, for instance, where you can have tens of different styles of doing it. So just like, you could be in fundamental investing, you could look at value, you could look at growth, you could look at sum of parts, you could do special situations, so many things you can do. Similarly, in value investing, there is no one set way of doing it. It's just that what you feel is the right way of catching the trends.
Got it.
There are momentum investors who have a fundamental filter also. So they may filter out stocks based on fundamentals. The stocks that fit their criteria,
Okay.
they will then look at from a momentum angle on those stocks. So you could do that as well. There are people who will do, for instance, filtering out based on momentum, and then say, okay, I'll add an additional filter if this also has earnings growth, or it has some particular pattern that some breakout patterns fit this. So there are so many parts that you can put together. It's like a Lego. I mean, you can set it up the way you like it. There is no one way of doing it.
Understood. So, are there any risks or challenges associated with momentum investing, especially in India in the current market?
I think India is the most beautiful market that is there for investing.
Okay.
A lot of youngsters and as well as old folks like me do not give so much credence to this fact that we have a runway of several decades ahead of us, which is sort of laid out for us. It's like a red carpet that has been laid out for investors, that you come to the market, you'll make money. I mean, you just don't have to do anything stupid. That's about it.
Yeah.
You just don't do anything silly. You'll make money just by default. You're putting money into index, you're making 11, 12%. I mean, this is virtually risk-free money.
Yeah, right.
So, I mean, this kind of opportunity is not there in many countries. I mean, forget, let's say, US or a few other countries. I mean, you look around you, the world, 200 countries are there. This phenomena is not there. I mean, this is a unique phenomena, by God's gift given to few places, where there is abundant growth ahead of us. So the new generation who's watching this, in their entire life, I don't think they will have a paucity of growth in our country here.
Yeah, that's
true. So this entire runway is already built. You just have to fly your plane on it. And not create any accidents on it. So very, very simple index investing, simple fund investing, simple any rule-based investing will do quite well in our market. So there is really nothing to fear about as such. Now, in terms of difficulties of momentum investing, as you very rightly pointed out earlier, that it is counterintuitive. So you need to throw out your established concepts in your mind that what is going up is bad and what is coming down is good. You will see very often stock is coming down, people are feeling very happy, that it's coming down, now I will be able to buy it.
Yeah.
Or stock is going up, they are fearful, oh, gir jayega ye, so you have to totally revert your thinking. A stock that is going up is telling you a story that I want to go up more. A stock that is coming down is telling you that there is something wrong with me, that is why I'm coming down.
Right.
Now a stock is coming down and a person is buying and it comes down further, person buying more, and they get stuck by doing averaging and all those kind of things. The stock was already telling you, please don't buy me. It is saying in capital letters, do not buy me. But you are saying, no, you are the best buy.
Right.
And stock that is going up is doing a green flag, I'm going up, I may do a sixer from here. And you are saying, no, the stock is telling me a lie, I cannot buy it at that height.
Yeah.
So it is a complete different mindset that you need to have. And younger generation has this advantage that they don't have any baggage yet. They've not spent 10, 15, 20 years in the market with that baggage of, buying low and selling high. So they can very easily catch on to these concepts. And the way the world is changing, the way, liquidity is flowing all over the world, momentum has done extremely well in US markets, in Indian markets, because it is all about liquidity flows. It is, you may be the most valuable market in the world, but unless the liquidity will come to you and the momentum enters your market, nobody will make money. A good stock that has been identified, with great value will sit there until money moves into it. And money will move into it once money realizes that there's money to be made.
Correct. So identifying that point ki chalo yahan se the stock is going to rally up more is the most challenging thing.
So I'll tell you a small thing about, let's say, 52-week high or all-time high. Generally, 90% people, if you ask, they will say 52-week high aa gaya, ab isse nikal jao. Get out of the stock, it has already gone to 52-week high. Now assume that, a stock is going from 100 to 1000, for instance, and its 52-week high is at 200. Now stock moves from 100 to 200, or let's say the all-time high was 200. So at 200, what will be your thought? The conventional investor will say, bahut badh gaya hai, the stock has gone up too much, let me get out. Right? So he has left that entire journey from 200 to 1000. The biggest gain of that stock of the last 20 years, he has left because of his fear. The stock was saying that I'm going up, but the mind said that no, I'm fearful, I want to get out of here.
Okay.
So it is like, the, what should I say, this Charles Darwin theory, survival of the fittest. The theory of evolution, that the fittest stocks will survive. And the fittest stocks are telling you that I am the fittest and I'm going further. But you're not willing to believe it because of your, biases in your mind. So any stock that goes to a new high or all-time high, in my view, is actually telling you that there is high probability that I will go higher.
In fact, I think I had read about a research where they said that if a stock is at its 52-week high, there is more probability that it will open a gap up the next day. So that is something that even I read.
So what happens is that, let's say a stock is trading between 100 and 200 for a long time. So some people would have bought it at 200, some may have bought it at 180, whatever. Next time when it goes there, the people who are stuck at 200 will cause resistance to the stock. So the price will not be immediately able to move up because there's too much supply coming in at 200 of these past folks who have been stuck there. Once all that supply has been cleared and you are at an all-time high, there is no overhead resistance. You can fly like a bird above that.
Makes sense.
Right? So it is, see, the market dynamics is like a, it's a very beautiful way to think about it. It's like an auction process. So, what happens in an auction, that there are buyers, there are sellers. The buyers keep bidding up till the sellers are exhausted.
Okay.
Right. Once the sellers are finished, buyers will fall on their own weight because there's nothing left now to deliver. Similarly happens in markets also, that the buyers will keep bidding up till the sellers are exhausted, and the price will then fall on its own weight. But the whole thesis is that if a stock is going low, do not buy it. If a stock is going higher, buy it. It is as simple as that. I mean, somebody, when they ask me, what do you do? I say we buy stocks that go up and we sell stocks that go down. This is our entire thesis, simplified into these 4 words.
Okay. And is there any particular way that you manage risk in your public portfolio, like the small cases that you have on the Smallcase platform? Is there any way that you protect the capital of the people who invest in it?
So capital protection is our biggest, you can say, focus area before we even design a momentum strategy. That there should not be any circumstance where we lose substantial capital.
Okay.
The way it is managed is that it depends upon the type of stocks that you're going to put in your portfolio. So for instance, if it's a large cap based portfolio, we know that the large cap movements are such that we can afford to have more concentrated portfolio, 10 stocks, 15 stocks, 20 stocks. If it's a purely a small cap portfolio, we know these stocks are very volatile, and hence we need to diversify across also. So we will have 30, 40, 50 stocks in those portfolios.
Okay.
So we tend to diversify the risk across that segment. And capital protection is, I personally don't like to lose at all.
Yeah.
That's my thing, that, like some people enjoy pain. I mean, you've heard of this, no? That the deeper the drawdown is on a stock, I mean, some people enjoy it because they think they can buy more, forgetting that they are already bleeding. So, some people enjoy the bleeding. I don't enjoy bleeding at all. I don't want any drawdowns in my portfolio, but that is not possible in the markets. Drawdowns are a part and parcel of being invested in the markets. So the idea is, and I'll give you a very nice analogy of this. Let's say you are running on the road and you fall into a ditch. Let's say the ditch was a couple of feet deep. You bruise yourself, you get up, you brush yourself off, and you start running again.
Okay.
Right? Versus a case where you are running on the road and you fall into a ditch which was 15 meters deep.
Yeah.
Now you can't get out of it easily. You've hurt yourself badly. You've probably broken 3-4 bones, and you can't get out of it easily. And once you are out of it, your confidence is shattered for running on the road.
That's true.
This is exactly the difference between having a system where you will fall less. You will fall less, but you will get up and run again.
Yeah.
But in your portfolio, if you fall deep, your portfolio is down 60%, 70%, 80%, you will never be able to recover from it, because to recover from a 80% down portfolio, you need a 5x returns to even come back to your original capital.
Correct.
100 going to 20. Now from 20, you have to go to 100 back again. You have to go 5x.
Yeah.
Whereas 100 going to 80, you only need, 25% more to come back to 100.
Makes sense.
So this is extremely logical way of approaching the market. But because we, as human beings have a lot of biases and a lot of, different ways in which we want to, put ourselves first in front of the market. We say that we know more than the market. That is so for me, value investing is I know more than the market. And and momentum investing is that I am nobody, the market knows more than me, I will follow the market.
Yeah.
This is the primary difference. When stocks are coming down, value investor is saying the market is wrong. They should be not valued here. It should be valued here. So I am right. My thesis is much better than the market. A momentum investor is saying the stock is going up. I think the market is right. Let me follow it.
Got it. Yeah. So you spoke about small and mid cap space as well right now, and you have a couple of small cases based on those stocks as well. So what are you particularly bullish on about in this space, especially in India right now, the SME space?
I think the SME space is something that comes even below, the small caps that we have on the main board. So that SME board is almost like nano caps, so they need to obviously grow and come to that main board on the exchange before they are well traded. But I think small caps, mid caps, they have a huge potential because I mean, if we are going to go from the current situation to 5 trillion to 10 trillion economy, and I don't doubt that this is going to happen, not happen. It is definitely going to happen. And these are the stocks that will become bigger and bigger. So, the potential of small and mid caps to do really well in the next 10 years, 20 years is huge. And there will be so many new stories, so many new stocks that will come to the market that, you don't really need to worry about, opportunities in the market. There are so many opportunities in the market, and you miss some, there should be no regret about it. I mean, it's like a new day every day. There is a new opportunity. Some people say, oh, I missed the COVID rise, or I missed this, I missed buying those stocks at those stage. I mean, I think it is just not a positive way to think about it. It's like every day there is a race happening, and you can bet on the new horse on a daily basis. So there is so much opportunity. There's so much money to be made. It's like you have a bucket and you're going to the ocean on the beach, and you can fill as many times as you like. The ocean is never going to end.
Yeah.
You and me will end our lives, but that ocean will never end. So there is no reason for anybody to be pessimistic about the market. There is no reason for anybody to regret whatever they may have done in the past. There is so much to do and so much opportunity there.
Right. So, sir, talking about some macroeconomic trends that are going on, I do follow you on Twitter, so I've seen some posts of yours as well on macroeconomic trends in the US right now. I think they're probably cooling off the increasing of US bond yields currently. So, do these events kind of impact your momentum model? Do you factor in these trends as well?
No, so we don't factor into our models directly, because as our basic principle, the BBC principle, Bhav Bhagwan Che, is that the price is already discounting everything that is out there. The price will discount it if markets are going up because of yields are coming down. The price is already telling us or discounting it there. Yes, for general interest, for knowledge sake, I do write a lot about macro things in the US, and I am also learning on a daily basis. I don't claim to be any economist or anything like that.
Right.
But I think it's very interesting that the US and the rest of the world is living on borrowed money from your generation.
Yeah.
So I believe your generation and the one that is coming after you is going to have a very tough time. Unfortunately, I'm sorry to say that. But because we are borrowing from the future, we are saying that we are living in a la-la land where we can borrow or raise debt as much as we like, but we don't want to pay it back. So there are countries which are now at 200% debt to GDP, 300% debt to GDP. I mean, money is not free. There's no free lunch in this world. Let's get this very, very clear. There is no free lunch in this world. If you are distributing money, it has to be earned from somewhere. The productivity has to go up, the growth has to go up to raise resources. You can't just print currency and hope that everything will go right. So there is going to be a lot of trouble in the coming decades on this front. It may not hamper my lifetime in the next few decades, but definitely in the times to come, this free lunch thesis will have to correct. So this entire monetary system that we have, and I'm going into a little of macro here, of a government borrowing and spending much more than what they're earning. So it is essentially what you and me also do. Do we spend much more than what we earn? Right. So what is the financial advice that we give to youngsters? That whatever you earn, you spend out of it and save something out of it. Why is that not applicable to governments and central banks?
Yeah.
How can they keep borrowing much above what they're earning out of taxation and keep spending on welfare, because the government wants votes, so they will keep spending on welfare. And so it is it is a zero-sum game at the end of it. I mean, you need to earn to spend that money. You cannot keep splurging money on whatever you like and not have the earning for it. Somebody has to pay for it, if not now, later. And that somebody paying for it will have to come through inflation. Inflation is that secret tax that happens. I mean, we never see it like that, but every year, if there is, let's say, 10% inflation, you are losing 10% of your wealth. You are losing 10% of your money in your bank without realizing it. You may crib about the tax that you have to pay, but you never crib about this inflation because this is a secret tax. And as that inflation will keep going up, because the more money you print, the more inflation it will happen. There will come a time where then all the central banks, all the governments will have to come together and say that this system is not working anymore. We have to do another, like 1944, they did a Bretton Woods agreement where they all sat down and said, okay, no more gold standard. We are coming and we are going to print money as we like. So something of that large nature will happen, maybe due to a world war of some kind or something like that. So there will be some disruptive event at some point of time. But yeah, I mean, it is going to be tough for newer generation. As you can see today, 20 years back, it was not as tough to buy a house for yourself, for instance. But for this generation to buy a house is getting even tougher. And it is going to get increasingly difficult as you go along, because wages are not increasing at the same pace at which the asset prices are increasing. So if somebody was earning 100 rupees and buying a house with the EMI of 10 rupees or 50 rupees, 20 years later, he may still be earning 200 rupees, but having to buy a house at 150 rupees of EMI. I mean, I have a very not so positive view about how things will happen for the next few generations. But right now, I mean, things are looking good.
So talking about next generation and disruptive technologies in the coming future, what do you think machine learning and artificial intelligence, how will that play out in your strategy particularly? And have you already integrated some of it, or what are your views on that?
I think the potential is there to wipe our kind of businesses out. Just like Zerodha did with brokerage, with zero brokerage. So there may be robotic advisories who will not charge you anything, and and give you better advice maybe. So it is definitely something that could be there. But I feel that the first hurting will happen in high frequency kind of trading / investing, where let's say people are running manual transactions on options or futures or things of that nature, where machines will take over, or algorithms are taking over. So like right now, there's a lot of algorithmic transactions happening on the exchange. Almost, I think 40-50% of all transactions are machine led. So those markets are becoming highly competitive, what's called the HFT, the high frequency trading environment, where the fight is that who has a better hardware, who has the better software, more efficient software, lower latency, who is more closer to the exchange server, so that the nanoseconds that are taken to execute the trade is faster. But ours is a very slow, laid back kind of style, where we do, we look at the portfolio once a week. There is no high frequency there. We have transactions, average hold of on our portfolios like 3-4 months. So I don't think there's much of disruption that can happen there as such due to machine learning. But you never know all these new age things, what may come and disrupt you. Also, while this is a lot of new things that are happening, a bit of it is also fad. From time to time, there are these new technologies which look like they will come and sort of conquer the world, and everything will go haywire, but then they die out. So at one point of time, it seemed like cryptos will take over the entire monetary system. or at one point of time, there were other technologies in late in 2000 where they said then that the year 2000 will crash all the computers in the world because the last 30-40 years computers had not learned how to go from 1999 to year 2000. So all these are, or the internet will sort of, internet has disrupted the world, but conventional businesses have adapted to it. So
Yeah.
I'm sure, there will be adaptations of conventional business along with it. Everybody is learning. And of course, I do fully agree with you that disruptions are going to be there. There will be people who will get knocked out of the marketplace. There will be companies who will not be able to, match up to these new age companies that are coming. And hence, buy, hold, and sleep does not exist anymore. That model is not meant for this kind of world where you will just buy something because the last 20 years have been good on that stock and hence the next 20 years will be good. That does not hold good at all.
Yeah.
So either you have a way of assessing from time to time whether this thesis is working or not, or you have something like momentum investing.
Yeah, understood. Thank you so much, Alok, for doing this. I think I've learned a lot from this 1 hour session that we've had. And any last word that you would want to say, Alok?
I would like to say, I mean, people view the market as a speculation or a gambling than that markets. See, 90% people have this view that you cannot make money in the market.
Hmm.
And that is also the SEBI statistic that 90% people are coming to the market and making losses because they're doing the wrong things. There is a lot of money to be made in the market. As I said, if you do nothing silly, you will automatically make money in the markets. So have confidence, allocate to the markets. Don't be afraid of falling down because that's a part of walking and running. You fall down sometimes and you get up and you walk again.
Yeah.
Don't be afraid of that. Market will hit you or punch you from time to time, but that's part of the game. And without your exposure to the market, without your exposure to equity, you will not be able to beat inflation. I mean, this is the key that anybody in any profession will have to have allocation to markets, to real estate, to gold, all these asset classes. And you need not be afraid of anything. You just come and invest and follow somebody, or you do it yourself, whichever format you like. Know yourself, know what your behavior, what your intent or your liking is, and accordingly you will be able to find something that fits you like a glove and you'll feel comfortable in it.
Got it. Thank you so much, Alok. That was really fun.
Thank you very much. Wish you all the best, and thanks to your entire team for setting this up. It was a pleasure to talk to you. And whenever I do these talks, I am also constantly learning because I get your perspective and I'm able to, think about things in my own mind also, what are we doing and where are we going? So thank you very much for having this done. Yeah.
Pleasure is completely ours. Thank you, Alok.
Thank you.